All right. So, Coffee Talk with Christelle, July. We are still in the month of July. And all of this information is going to be timeless, meaning at any point you can listen to it. But I'm also recording it and going live in the month of July. What is the month of July? July is Freedom Month. Second. Let's make sure I'm recording this too. Yeah, so let me start over with what is this month? The month is the month of July. This is when we're recording this. However, this is a timeless. Is that correct to say timeless? So July is the month of freedom, flags, fireworks, cookouts. Everyone's talking about independence. But here's what nobody's saying out loud. A lot of you listening or reading this right now, as you can read the comments and not, you actually don't feel free. You feel trapped. What do you mean, Krista? I feel trapped. Who told you I'm feeling trapped? In your house, in your finances, in decisions you made that made sense at the time, but now you feel like you're in a cage. So today I'm going to be naming 5 traps I see people stuck in every single week. And unlike most people who just tell you the problem, I'm going to go deep on 3 of them today. The trap, the actual way out, one of the ways out, multiple ways of possibilities in the world of infinite possibilities. Before I even get into them though, comment right now which one you think is you. The golden handcuffs, the equity rich but cash poor, self-employed income trap, investor silly, or the do nothing trap. Which one do you think is yours? So let's get right into it. Let's go. So real quick, here are the 5 traps, which I've just named them, but I'm going to go a little bit deeper in the first 3 today. Trap number 1, the golden handcuff trap. You've got a real great rate locked in. You've been in your home the last few years, great interest rate, but your life has outgrown the house. You're staying for the rate, not because it fits you anymore. That's what we call the golden handcuff trap. Trap number 2, the equity rich and cash poor trap. Your house is worth more than ever. We've seen that in so many markets, so many subdivisions, so many homes, like from the macro to the micro. But that value is stuck in the walls. You look wealthy on paper, and still that feeling inside that you broke each month, month after month. Trap number 3, your self-employed income trap. You write off everything to lower your tax bill. Smart move. Then you get told you don't qualify for the same reason, because you wrote off too much. Trap number 4 and number 5, we'll get in next week. So we're going to go deeper in 1, 2, 3. So save this video because 4 and 5 get the same treatment next week. So let's start with the first one. Trap number 1. Your low rate isn't keeping you free. It's keeping you stuck. You bought your house a few years ago and locked in at, I'm still seeing those rates of 2.75, 3, and 4s. Great move at the time, of course. Great still move right now. But your life has changed. We're talking about years now. We're not talking about last year. We're talking about 3, 4, 5 years ago. Actually, more 4, 5 years ago. And life changes. That's the thing we know. Constant change. Bigger family. Job change. Need more space. Want less space. Whatever it is. And moving means giving that rate up for today's rate, which is, as we know, double what we've mentioned before. So you stay, not because the house fits you anymore, but because the rate does. I love my rate. I don't want to give up my rate. I literally hear clients say that, and I understand. But that is not freedom. In the month of freedom, that is not freedom. That's the golden handcuff. You're financially smart, personally stuck at the same time. I talk to people all the time who are living in a house that no longer fits their life purely because they're scared of losing a number on paper. Here's the move most people don't know about. You don't have to choose between keep my rate and get more space. There are strategies to keep your existing low mortgage rate in place while still also accessing what you need. For example, you can use a smaller loan against your equity instead of touching the first mortgage at all. But here's the piece almost nobody talks about. The low rate doesn't have to just sit there once you move out either. If your income has grown since you bought that house, or maybe you have now married or there's a partner, there's that extra income, right? You might not be able to keep it and you turn it into a rental. Think about it. Your payment is low, which is why you also love it, compared to today's rents. At the same numbers, could work for you would work for you in your favor, could work in your favor. So you move forward into the new home that fits your life now. And instead of walking away from that old rate, it becomes an asset working for you every single month. That's the real reframe. The handcuff isn't just something to escape. In the right situation, it's something you can flip into your investment property. So if this is you, because remember I asked at the beginning which one you might fit in, tag or share this with someone you know who's sitting in a house that no longer fits them because of their rate. Chances are they haven't thought about this option, and it might be exactly what they need to hear today. The freedom of moving forward and now utilizing the low rate to increase their portfolio and their assets and cash flow. There are, of course, other options, but this is one that you really want to sit down and let's talk about the numbers. Does this make sense based on this market? So share with a friend or someone who's sitting on a house that no longer fits because of their rate and they need to make a move. Okay. Now let's talk about trap number 2. You can be a millionaire on paper and still feel broke every single month. I'm just going to use that example because we just had the World Cup, right? You know, all those, the athletes, not necessarily the soccer players, but the athletes, they have money, millions, but then they might still feel broke because their mindset and how they're moving and incorporating their new earned assets, like, hey, I'm sitting on so much cash that I didn't really work for it. I'm not saying the athletes didn't, they worked for it. You made the right investment, but you're sitting on that cash, but you still feel trapped. Your house has gone up in value. On paper, you're doing great. Your net worth looks good, but none of that value is in your pocket. It sits in your drywall. So you got this weird disconnect. You're wealthy according to a spreadsheet, but you're still stressed about tuition, medical bills, slow month in your business, whatever it is. Being asset rich and cash poor is one of the most common traps I see, and it's one of the most invisible ones. Nobody posts about it. You just quietly feel broke while everyone tells you how well you are doing. And this is where it gets real. There are a few different doors, and which one is right depends on what you actually need. So I'm going to share a few of them. If you need ongoing access to funds, not just a one-time lump sum, think of it like a credit card backed by your house, where you only pay on what you use. If you need one lump sum right now for a specific purpose, a second loan, like a HE loan on top of your first, that gives you cash without touching the original mortgage. Another one, if your current rate isn't great anyway, and that's by doing a blend, right, of those payments of the first and the second, like if we were to do a blend, you're replacing your whole mortgage with a new one and pulling cash at the same time. But here's a punchline, and it's the part most people skip. The numbers don't lie. It's not just about the size of your equity. It's about what actually happens to your monthly cash flow once you add a new payment on top of what you already have. That's why you sit down, you take real pen and paper, and you write your budget. You run the actual comparison before you touch anything. Okay? And here's the mindset shift a lot of people need. Getting a line of credit or a loan isn't automatically the smart move. If you're already carrying debt at a lower interest rate than what the home equity would cost you, taking one more debt against your house to solve it can actually leave you worse off, not better. So don't fall in the trap of trading a manageable debt for a bigger one just because it feels like you're progressing. Like, hey, everybody's talking about HELOCs or line of credits. Let me go ahead and get one. Sometimes the numbers say, wait. Sometimes they say, go. And the only way to know is to actually run the numbers. Run the numbers. Pen to paper or your calculator. So don't just nod along with what I'm saying. Actually, I want you to sit down and pull your cash flow. Where's my pen? It drops like my paper. Pen to paper, right? Your monthly payment, your other debts and their rates, right? You want to go ahead and have that. How much am I paying? What's my rate? What's my balance? Of course, credit cards, even if I'm just doing minimum payments, how quickly am I going to pay? So you really make that analysis. What's coming in versus what's going out? Once you have those actual numbers in front of you, that's when we can come together and look at whether one of these options genuinely makes sense for you. Not automatically, I'll say you need to do this or do that because this is the hot topic. It depends on your long-term goal, depends on your cash flow, what's coming in, what's coming out. Okay. Now, trap number 3. The better you get at running your business, the worse you look to a bank. If you're self-employed, you already know this. You write off everything you can legally write off because this is small business. Lower your tax bill. Keep more of what you earn. But then you go to buy a house or refinance a house, and suddenly that smart move makes you look like you don't make enough money. The bank looks at your net income after write-offs and says you don't qualify. Going to even say you're working for a company, you're W-2, but the market dictated for you to go ahead and open your business. Now you are self-employed, a couple of years of being self-employed, let's say, in which you were able to qualify before versus now on paper looks different because W-2 versus self-employed, and you're trying to maybe refinance your house. So I want you to picture this. Another scenario. You're a photographer who brings in $150,000 a year. Write off the gear, the mileage, the home studio, editing software, all legitimate, all smart. But the time her tax return or your tax return is done, your qualifying income on paper look like you make $60,000. So a bank that's reading only that number sees someone who can't afford the house because we're doing a debt to income ratio based on $60,000. When in reality, she could comfortably afford this home because she actually makes more. So the better you are at running your business, because now you know how to write off those things, the worse you look on paper on a traditional lender, to a traditional lender. So you're actually getting punished for doing exactly what you're supposed to do as a business owner. So that's actually backwards. And it's actually very exhausting for self-employed people who are being told no. And here's what changes everything. Traditional lenders only know how to read one story, your tax return. But there are programs built specifically for people like you that look at because I'm one of those lenders, right? We look at the real story. Loans that qualify you based on your actual bank deposits over the past year or 2 years instead of your tax return. So we're not looking at your tax return. Loans that use your 1099 income directly, which is especially helpful if you gross on your 1099 income a lot higher than what you net on your taxes on your Schedule C. Or loans where your accountant, your CPA, prepares a profit and loss statement or stands in for your tax return entirely. We don't look at your tax returns, you look at your profit and loss. So none of these actually require you to change how you run your business or file your taxes. They just require working with someone who knows how to read your actual financial picture instead of forcing you into a box, W-2 employee. So if this is you, don't let a tax return define what you're capable of. Pull your last 12 to 24 months of bank statements or your 1099 and look at the actual gross numbers, not the number after everything is written off. That number is closer, not exact, but it's closer to the truth of what you are really earning. And it's that number that should be driving your next move, not the one built into someone else's situation. So look at your taxes. You might want to put them aside and pull your bank statements. What am I really earning? So today we've covered 3 traps and 3 real ways out: the golden handcuff, the equity, rich cash or trap, and the self-employed income trap. Next week, we're going to cover at least 2 more traps: the investor ceiling and the one that I'm doing nothing trap. Like many people are doing right now, doing nothing trap. But I want to how to get out of those 2. If any of today's 3 hit close to home, we'd love to hear your comments. Which one? It may not be you, be a friend, right? Which one you've heard somebody say that they're experiencing. And I'll see you next week on Investor Ceiling Trap and Do Nothing Trap. And maybe based on your comments, we may be diving more. So I look forward to connecting with you. Thank you so much.